Good afternoon and welcome to this Yellowstone Advisory webinar with Rotork PLC. We're delighted to have with us today CEO Kiet Huynh and Director of Investor Relations Andrew Carter. I'm now going to hand over to Kiet to take us through today's presentation.
Good afternoon, everyone. Hopefully you can hear me and see the screen. It's great to be here. So thank you to Alex for hosting, and thank you to everyone who has joined this call. I'm going to take us through today the results presentation that we gave in March, and then open the line up to questions at the end. So we'll start with our normal disclosure slide, and I'll let you read this in your own time. So moving forward, this is the agenda for this session today. I'm going to go through some highlights of our results and look back at 3 years of Growth Plus. Ben, our CFO, has earned a well-rested holiday, so in his place is Andrew Carter, our IR director, who'll take you through the financials of the company. I'll then come back and give you an update on Noah, our recent acquisition, and an update on Growth Plus before we open the floor to questions. So let me start by just reflecting on a strong year in 2024, where we saw some really good growth. So the group delivered 8.2% of organic growth, delivering 23.6% operating margins and a closing net cash of 125 million. So really strong performance from all of the Rotork team involved. Within that growth, Rotork Service grew ahead of the group and is now 23% of group revenues. Return on capital employed also continues to be strong at 37.3%. In terms of safety, our number one priority, we've also made a really good progress in the year, and our TRIR number, our total recordable incidents, is 0.22, an improvement on the 0.26 from 2023. So these are the highlights of our results. We're very pleased with our performance, and together with the team delivered a very strong year. Looking back at 3 years of Growth Plus, I'm pleased to report that we have made some really good progress, and we're confident that the strategy, the Growth Plus strategy that we laid out 3 years ago, is really delivering in terms of our financial ambitions of mid to high single-digit revenue growth and mid-20s operating margin. I think, in fact, that over the last 3 years, we've grown the group revenue at a 10% CAGR year on year, with oil and gas leading the way at low double digits, with water and power and CPI at high single digits. Adjusted operating margins has also grown 110 basis points, and Rotork Service has grown again ahead of the group at 14% compound annual growth rate. Return on capital, again, still is very strong, and that grew at 720 basis points. So all in all, over the 3 years, we're very pleased with the Growth Plus strategy, and we're pleased that we can show that the strategy is working by delivering these results, as you can see on the screen. I just wanted to take a minute to focus on the target segment strategy, which is a key pillar of our Growth Plus strategy. So this is part of the strategy where we focus on key target segments that have got high growth market drivers, where we can capitalize on to deliver higher than above market rates. This will help us deliver our mid to high single digit financial ambitions, as we've stated. So I'm pleased to report that our target segments grew at 9% year on year. And these are segments such as upstream and midstream electrification, critical HVAC within CPI, and water and power. So sectors such as water infrastructure, wastewater treatment, and desalination, all very good target segments for us. Within 2024, the core segments also grew very strongly as well. Now, these are the segments where we have high market share, and these are segments that are typically more mature. So here we will grow with the market growth rates within these segments. But last year was a great year for both target segments and core segments, allowing the delivery of the 8.2% organic sales growth, as you've seen. I think for those new to the Rotork story, this slide really paints a picture of why Rotork can consistently deliver high margins and high return on capital employed. And it's basically through our brand strength, our reputation in terms of having the best product quality on the market. So Rotork is known as a brand leader, especially in electric actuation. We have a nigh on 60-year reputation of having the best products on the market. And especially if you're delivering into critical application where there's a lot riding on if your product goes wrong in terms of health and safety or in terms of downtime for your plants, product quality and product reliability is absolutely key. And Rotork is a leader in that respect. Having a site service or a service capability is also extremely beneficial. So we have our own service network. We have the biggest global presence with that service network, and it really helps to give us differentiation in the market with our end users. With all of those attributes, there's actually really high barriers to entry within our markets. There's a low number of competition, and because it's critical, the markets are critical in nature, it takes quite a lot for new entrants to take hold, and typically they find it very hard to take hold, hence the high barriers to entry and effectively the moat around this business. This is why we have and continue to have such high returns. So hopefully you can see there this demonstrated in the return on capital employed from 2021 to 2024 with the 720 basis points improvement, as I've mentioned previously. In terms of our capital allocation, this is just a reminder of our capital allocation framework. So organic investment is the number one, and we continue to do this throughout the Growth Plus strategy. Progressive dividends is number two, and I think we've delivered progressive dividends for the last 20 plus years.
20 years, yeah.
Which is absolutely fantastic. Then comes strategic investments, which essentially includes M&A, and then the return of cash to our shareholders. And you can see with the graph there on the left that year on year, we have progressively continued to deploy our capital. Over the last couple of years, or 3 years, we've made 2 acquisitions, the first being Hanbay in 2023, and the second this year with us completing on the Noah acquisition. We've also, in addition, have done a buyback in 2024, and we have announced that there's an additional 50 million buyback this year. So you can see there we are continually deploying our capital in a very disciplined way according to our capital allocation framework. With that, I'll hand you over to Andrew to take you through our financials.
Great, thanks, Gig. So this is just provides the financial highlights of 2024. Gig has touched on a few of the numbers on here, so I won't necessarily run through them all, but I think the highlights for us, clearly the 8.2% organic sales growth during 2024 is a real highlight and really confirms that the Growth Plus strategy is delivering. I think we'd also point to the improvements in the operating profit margin and 100 basis points constant currency improvements in margin. It really shows the operating leverage that the business has got and was a very encouraging result. Cash conversion remains very strong, 119% in 2024. And the ROCE, as already mentioned, up at 37%, is amongst the highest of not just industrial sector businesses, but listed businesses more broadly, and a very encouraging number to highlight. We mentioned already the dividend increased again for more than 20 years now, and increasing that by 7.6% in 2024. Just moving on to the next slide. Thank you. We've just got a couple of slides providing the divisional highlights of the year, starting with oil and gas. Oil and gas achieved low teens organic sales growth in 2024. That was driven by the electrification trend, one of our target segments, focusing on the electrification of actuators used in the upstream and the midstream, and also the strength in the downstream sector that we saw in 2024 across things like refining and also hydrocarbon storage. Margins were close to 26% in 2024. That's a record, something at the highest number that we've ever achieved, so very encouraging there. And in terms of the split of sales, you can see from the split that we give there on the slide that the downstream was up to 52% contribution to oil and gas sales in the period, up from 49% before. So all of the segments grew in the year, but downstream there was the strongest. If we jump onto the next slide, just to talk a little bit about CPI. So CPI sales were actually slightly lower, 1.1% down on an organic constant currency basis. This was largely due to reduced mining activity. We saw a number of, in particularly one series of larger projects in the first half of 2023 that didn't repeat in 2024. And that's really the explanation for sales for the full year being down. Growth, however, did resume in the second half. And I think that the outlook, which we'll talk to in a little bit for the CPI business, is positive. The margin performance there was very strong, adjusted margins up to 25.8%. That's a result of a few things, a little bit from mix, but also disciplined cost management from the team. CPI remains a very attractive business. We put on the strapline on the slide here that the organic revenue CAGR over the last 3 years for CPI is approaching 9%. So it continues to be an important part of Rotork and the part of the business that we think has got some very, very attractive fundamental characteristics. If we jump onto water and power, Water and Power had a very, very encouraging performance in 2024, as it did actually in the previous year in 2023 as well. So organic sales growth was approaching the mid-teens level. Really, they're driven by global infrastructure spend across both of the sectors, across water and across power as well. On the margins were strongly ahead, but reaching 29.1% and back to the historical peak that we've seen for the division if we go back a few years. So a very encouraging performance from Water and Power for a second year in a row. We just jump onto the next slide. This is our operating profit bridge, breaking down how profit improved from 2023 to 2024. And I think the key takeaway to make really from this slide is just to recognise the strong operating leverage that Rotork has on increased revenues. You can really see that across this bridge. A couple of other points to make on here. One would be to talk a little bit about price and just sort of to make the point that following a period of a few years where inflation of industrial goods prices was running at quite high levels, that has now normalized for us. And the price was in the region of like plus or minus 2% for us in 2024. So back to much more normal levels than we've seen in 22 and 23 before that. You might also notice the slightly higher number there for OPEX investment. There's a couple of things in there to be aware of. We wouldn't point it to suggest it was in any way unusual, but what we have got in there compared to the previous year is higher variable compensation and also some investment to support the Growth Plus strategy in things like commercial people, business development people, and things like that. So that's the adjusted profit bridge. If we could just move to the financial guidance and the financial summary. Really, the summary here is a year of strong progress with good sales growth and margin improvement, a year that we're all really, really proud of. In terms of the guidance here on the slide, this is really to sort of particularly mention, I guess, currency, which as we sit here today, looks likely to be a headwind to sales and profits again in 2025, as it was in 2024. And also just to mention the investment that we're making in our business transformation. So this is where we're working to significantly improve our IT systems and implement new ERP systems across the group. And we're talking about a higher level of investment in 2025 than we made in 2024. And in terms of the summary that Ben gave a couple of weeks ago, we see the outlook for our end markets as positive. We're also pleased to report that the order intake, which was pretty encouraging in the final couple of months of 2024, continued to be encouraging in January and February, something that a lot of the analysts were talking to us about a couple of weeks ago. And I'll leave Gig to provide the sort of the more formal outlook, but we're talking about another year of progress in prospect for 2025.
Right, thanks, Andrew. If I can give you some updates now on the Noah acquisition, Growth Plus, and then I'll end on our outlook. So we're really pleased to have announced the completion of Noah Actuation as part of Rotork in March. Noah is a fantastic company. We've known them for over 5 years now. We've built up the relationship with them. They produce electric actuators, which is a portfolio enhancement for Rotork. So Rotork actuators typically go on valves that are, let's say, 12 inches or above. Anything below, historically, our products were too overspecified to really operate in these valves. But what Noah does, it brings in the complements to that. So now actually we have hand bay, which we did a few years ago to go on valves which are about 1 to 2 inches in size. Noah goes between, let's say, 2 inches and 12 inches. And it really gives us a advantage for our key target segments, especially within water and power and within CPI. It will also have benefits in our oil and gas upstream and midstream electrification target segments. So brilliant acquisition for us, really, really excited about it. And we can't wait to have them on board. So that's Noah.
Just to add, because it's not on the slide and predicting the question, we paid £44 million for Noah. And you can see where we estimate the 2025 sales and EBITDA will be on the slide.
Thanks, Andrew. So I just wanted to take us back to our target segment strategy and just to elaborate a bit more on that. As I said, the target segments grew at 9% year on year. But this really is the key part of the strategy that has allowed us to deliver the growth over the last few years. And what we're targeting are markets which have high growth opportunities, markets where we are new into or underrepresented and which we can make large, let's say, or rapid market share gain. So these are the target segments, 50% of our business that we believe we can return high growth on and where they have structural growth drivers within them. That coupled with our Rotork service business, where we're growing ahead of the group in terms of growth percentages, they're the two key elements which has really helped us drive growth over the last 3 years. Moving on to service in a little bit more detail. As I said, service grew ahead of the group. It's now 23% of group revenues, and it's a major differentiator for us in the market. So as well as our products, we have the leading service offering with the widest global network of our own service teams. We offer a number of capabilities, but essentially the growth opportunity within service, or the growth strategy within service, is to increase the number of intervals in terms of the servicing that we do on our product, and increase the amount per service interval. We do that by offering our field service capabilities, which is site service support, upgrades, maintenance. We then couple that with what we call our product care programs, where we offer extended warranties or product care packages, where we can offer a service to just maintain and to make sure the uptime of the equipment. We then have connected services where we leverage our intelligent asset management programs and our connected products. This allows the plant users to understand what's going on in the actuator and the valve. They can see and they can monitor the performance of the valve, and therefore have predictive maintenance and service before unplanned shutdowns or unplanned downtimes. That's really beneficial to our customer. And then we base all of that around our support service, where we provide technical training and support for our customers. Essentially, what we're trying to do is, over the life of a product, which could be 15 to 20 years, we're looking to generate up to 4 times the value of the original product sale for every single product that is sold. So this really is driving resilient business for us, continued resilient business. So I'll just give you an update on the outlook within our markets. So notwithstanding the current geopolitical and the macro uncertainties, we've chosen some key target segments where we think have got some really good underlying growth drivers. So within oil and gas, upstream and midstream electrification trends continue. Operators are seeing the benefits of electrifying applications which were originally either pneumatic or hydraulic controlled. That includes applications such as the methane reduction initiative, which we've launched, or actually fracking platforms, where we've delivered, or we've helped our customers deliver the first e-fracs, which are set to continue. Gas and LNG, again, has underlying good drivers. I think LNG is a really good transition fuel, and we're starting to see the orders of the LNG liquefaction sites that were built 3 or 4 years ago come on stream now, and we're starting to see those orders, and that should continue over the next few years. In terms of chemical process and industrial, we're seeing good structural growth drivers in HVAC, especially HVAC within critical applications such as data centers, semicon plants, and areas such as those. We're seeing very good growth. We're seeing positive outlooks for specialty chems. So whilst the chemical market in itself hasn't seen great market growth, our focus on specialty chemicals has really seen us deliver really good growth, and we see that set to continue going into the future. Mining, other than nickel mining, has also been very strong for us, as well as marine. So the key elements in CPI is to win share in target segments where Rotork has historically been underrepresented, and therefore we can make quick market share gains. Within water and power, water has been consistently an area of investment focus, and that's been across the regions in the Americas, in EMEA, and in Asia Pacific. And Rotork is really well positioned to capitalize on that growth. We've delivered a 13% compound annual growth rate in water alone over the last 3 years. So that really shows that with the good key markets growing, we can really capitalize on that. And it's a great example of how a target segment strategy is really working. In terms of power, traditional power is actually coming back on stream. And we've seen the likes of the big oil majors focus more on traditional power and less on new energies. And that is a positive for Rotork. So we're seeing an uptick in traditional power, things like gas power, turbines, coal power turbines. Nuclear is coming back on stream, where Rotork has a very large install base, basically from our history. So traditional power is coming back, and we see the signs are positive there. In alternative energies, that's really quite new, but we are well positioned, and we've done quite a lot of work in the past to be ready if that takes off. So underlyingly, we believe we've chosen the key markets with underlying drivers. However, I do caveat that with the uncertainty that's going on currently that you're seeing in the globe. So with that, I'll end the presentation with a summary. Growth Plus really is delivering our vision. In the last 3 years, we were able to deliver a 10% compound annual growth rate, with last year delivering 8.2%. We're heading towards our target of mid-20s, and last year we delivered 23.6%. We have always had strong cash conversion and return on capital employed, and last year was no different, with 119% cash conversion and 37.3% return on capital employed. Progressive dividends, as I've said, we've really kept to our capital allocation policy. We've delivered annual dividend growth for 20 years plus. And this year we launched an additional 50 million share buyback, the third in the last 4 years. And we're pleased to announce the acquisition of Noah, our complementary product enhancement acquisition for Rotork. With that, thank you very much for listening, and we'll open the floor to questions. Thank you.
Thank you very much, Gig. Thank you very much, Andrew. As Gig said, we're now going to open the floor to questions. And if you'd like to ask a question, please could you use the Q&A box at the bottom of your screen, and we will try and come to as many questions as we can in the time available. I'm just going to start off with one that came in ahead of time. It's looking at consensus estimates. So this is the question. If I look at consensus estimates, they appear to be lower post the results, and the FY25 EPS forecast is falling relative to FY24. Why is that?
Andrew, do you want to take this one? I think.
Yeah, I will. Yeah, thanks, Gig. Thanks, Alex. Yeah, I'm not sure exactly where you're getting that from, whoever's sent that question in, but I will look into it afterwards, and I'll see if I can sort of try and work out where it's come from. We have an up-to-date consensus on our website, which you're more than welcome to have a look at. But the consensus of the analysts who've updated numbers since we reported a couple of weeks ago is for sales in 2025 of 805 million or 804 million, which is around 6% higher on an organic constant currency basis compared to 2024, and also for a 50 basis points from the top of my head improvement in operating margin, up to somewhere in the region of about 24.1%. The increase that drives in earnings per share, I'm not exactly sure off the top of my head, but it'll be in the region of around 10%. So we are seeing the market is expecting us to continue to deliver good revenue growth, margin improvements as well. As I say, I will take a note, and my homework for later on is to try and find out who's misrepresenting our financial performance and see if I can sort that out.
Given the track record, we should expect no less than continued growth in all those metrics. So thank you for clearing that up. Next question here. Rotork shares were back at this level in 2019. Why do you think the share price hasn't progressed since then, despite growing sales and profits?
Yeah, that's a really good question. And I think there are a number of factors to consider. But if I start with internally, I think what we've got to do is focus on growing the business, and we're very pleased. I think you can see it in the presentation with the Growth Plus strategy. We've grown the business at 10% compound annual growth rate. We're heading towards our mid-20s. That's the number one focus of myself and the management team as such. I think there are external factors at play in terms of the share price, which hasn't helped us in the global kind of macros. I think outflows is a key driver. But I think, Alex, do you want to say anything on outflows?
Well, I guess just on outflows, I mean, if I look at the Carlstone data, which looks at flows into sort of equity markets across the globe, I think there was around about a 12 billion outflows from UK equities in 23, 9 billion again in 24. And the first 2 months of this year have shown outflows again, with over $1 billion coming out in February. So certainly the outflows don't help not just Rotork, but all of the companies listed in the UK equity market.
Yeah, thank you. So I guess for us, we'll focus on delivering the strategy. We obviously have a number of things that we will look to do to continue our performance, and hopefully the share price will respond.
Yeah, perhaps just to add to that as well, because the time frame I think that the person asking the question said was 2019. One thing to reflect back on that period from probably maybe even 2018 through till 2020 or 2021, we did see very, very unusual bond yields, bond yields being very, very low. And that sort of, that impact kind of translated into the equity market in the highest quality of companies with very high return on capital employed and great track records and things, seeing their multiple being re-rated quite substantially. I think Rotork was one of those companies that benefited from that. And so what we have seen since that period is we've seen a little bit of a de-rating, but the rating has kind of gone back more to the period before we went into that slightly unusual period of very low bond yields in 2018 through 2020. So I think there are a few things that have kind of played a part. Hopefully we've seen the back of those and fundamentals can reassert.
Thank you. Question coming on here on your sales. What % of your sales are for new investment projects by clients, and what % are for maintaining clients' existing operations?
Yeah, that's a really, really good question. We actually don't measure new investment and current, let's say, brownfield improvements, but because it's very difficult to do that, because a lot of our end user or customers will sometimes do both at the same time. But if I think about it in terms of a lot of the service work, or all of the service work, will be for brownfield, so that's at least a quarter of the business, circa a quarter of the business. We have published a stat that says actually only 5% of our business are from orders over £1 million. And what we equate that to, that actually that's capex, so that's new. The rest, I think around 50% of our business is from orders between £10,000 and £100,000. So that's more, I think, to do with refurbishment and upgrades. But within there's a little bit of a difficulty, because it could be a refurbishment or a capacity expansion of an existing facility. So do you class that as new or existing? That's why we don't really class that as that. But if you think about it as what is capex and what is opex, I think around 5% would be, let's say, big capex projects, and the rest is more like an opex budget spend.
Thank you, and quite an interesting stat that is, isn't it? Very interesting.
Yeah.
Next question here. With some parts of the world looking to de-emphasize green policies, are you likely to be a beneficiary of such moves?
I think on the whole, yes. Yes. And I see it as more of a longer term demand profile. So I think we've seen some big oil majors come out and re-emphasize reinvestment back into traditional oil and gas. I think that can only be good for long-term longevity of that market, and therefore that's positive for Rotork given the exposure or the end markets that we have in terms of oil and gas and power. So overall, yes, I see that as a positive.
Okay, thank you. Who are your biggest competitors?
Yeah, so there's really some, let's say with us, there's probably about 4 big players. there is a company called Alma, A-U-M-A. They're a private German company. They solely specialize in electric actuation and gearboxes. I would say that they're our biggest competitor in electric actuators in water and power. They're not so prevalent in oil and gas. And then you have the other two big companies, US companies, Emerson and Flowserve. And they are more like a conglomerate. They do actuators, but they also do other products such as the valves, the pumps. In the case of Emerson, they've gone up the technology stack, and they will do the kind of control systems that are controlling the hardware as well, which we don't do. So they're the kind of four big players within our industry. We are kind of seen as the leader in our markets, especially in electric actuation.
Thank you. A very topical question here. How might tariffs affect growth this year and next?
That's a really good question. And with tariff, things are changing by the minute and by the day. We're up to a few weeks ago, you know, we had mapped what was the tariffs that were impacting Rotork, and the impact was actually quite minimal in terms of the primary impact, in terms of the tariffs that would be affected on us. However, there is a secondary impact with tariffs, which I don't think anyone really predicts. And I'm not an economist, so I wouldn't like to go and predict what the secondary impact is. But I can see that inflation could rise with all of the tariffs. With the rise of inflation, I mean, we've just gone through a period of increased inflation. So there could be some economic headwinds due to inflations. However, just like the last high inflation period that we've been through, Rotork does have a lot of pricing power, and we've shown that over the years that we have been able to overcome pricing increases. We've been able to pass those on and protect our margins based on that. So either way, we're quite comfortable in terms of the margin, the tariff impact. If it's high, we can pass that through. Currently, what's directly mapped is minimal. The bigger, wider question is, will it drive, you know, economic uncertainty for a downturn? Potentially, but I don't think any company therefore will be immune to that.
Okay, thank you. You seem to be confident about the outlook for 2025. Would you be immune from a US recession?
And I think I link that back to the last one. I think the markets that we have chosen, we're confident that we have good underlying growth drivers. However, I don't think anyone is resistant to a US recession. I think we will be hit just like any other company would be hit with a US recession. We will look to be resilient within that, you know, like we have done in the past. We'll look to protect our margins, and we'll look to do the best that we can do. But like I said, I don't think any one company would be resilient to a US recession.
And perhaps there, just to mention, Alex, just to remind what we did say was that in terms of our order intake in the final months of 2024, that was pretty encouraging, and that continued in January and February.
Yeah.
So we have started the year with you know, with a pretty good order backlog based on that sort of order intake. So it's very much a case of being very important that the Rotork people keep an eye on what they're seeing in terms of what customers are saying and order trends and inquiry trends and things like that. But we haven't seen anything at this stage that makes us sort of be feeling that there's a US recession ahead.
Yeah.
But we're obviously reading the same kind of things and seeing the same indicators in stock markets and things like that, as well as the listeners who asked the question here are.
Thank you. I've got 3 questions here on M&A stroke the NOAH acquisition, so I'm going to ask them one at a time, but together. The first one is, was the NOAH acquisition a competitive process, and why are they selling now?
Yeah. Do you want me to answer one by one? Okay. No, the NOAH acquisition was not a competitive process. And actually, this is how we have developed quite a lot of our M&A pipeline. So what we do is we look to build relationships with privately owned companies, and therefore we can do the deal off process, not in auction. That's really good because then we can, you know, look to pay a good price and prices that meet our financial hurdles. The reason why they're selling now, look, we've had a relationship with them for over 5 years. We've actually been private labeling their products in that time. We have established the trust and the relationship, and you know, we were able to convince the owners that this was a good time to sell. You know, the owner himself is retiring from the business, and he wanted to make sure that the business had a good home. And with the culture that Rotork has, you know, he was confident that you know, there was a good home for the company that he built to go to.
Great, thank you. Second question here: does Noah also use manufacturing light as Rotork does? And if not, will you change the Noah approach?
100%, and thank you for the question. I forgot to mention that on the slide. It mirrors Rotork identically, and this is why it was so excited about it. So it has an asset-light manufacturing approach. It buys components, it assembles and tests, and then it ships. But obviously, it designs all of its own products and has the IP for those, which we obviously now have.
And then finally, there's the third question in the M&A series: are there further acquisition opportunities in the pipeline?
Yeah, look, I'm really pleased with our pipeline. We do, as part of our capital allocation policy, look to make more M&A. What's in our pipeline is more bolt-on type M&A, like Noah. Noah is probably a perfect sweet spot, you know, as close to the center of the fairway as you can get. And we have a good number of those in the pipeline. The difficulty is with the privately owned companies is it's really hard to time. You know, but the good thing is that you can make sure you pay the right price for them. You know, we have been involved in a number of acquisition kind of auctions, I would say, over the past few years, and typically the prices that private equity are willing to pay do not meet our financial hurdles. So this is why we've gone down more of the kind of owner-owned approach, and that seems to be paying off.
Thank you. You've got an above average exposure to the oil and gas industry. How correlated do you think the business is to the oil price?
So yeah, I mean, we have oil and gas is about 47% of the business, but half of that is actually gas. So you could think of oil as about a quarter of the business. The oil and gas business is not actually directly correlated to the oil price. As long as the oil price is above a certain amount, which is what we call the break even. And a break even really ranges, depending on the application, between $35 a barrel to $50 a barrel. If the oil price is above that, investment continues. What the actual end users look at is more of consistency of the oil price, because what they're trying to do is calculate paybacks over a long period, and a high fluctuating oil price doesn't really help them. A more consistent oil price above the break even actually helps. So anything above, any fluctuations above the break even doesn't really affect us, doesn't really correlate. It's more, for us, it's more about demand, end user demand, economic demand. That's really where the driver is.
And perhaps another way to answer that question is just to remember the split that we gave of the upstream, midstream, downstream, and perhaps just to sort of recognise that other oil and gas service and equipment companies, they do tend to have quite a lot more exposure to the upstream. We're a little bit unusual, having more exposure actually to the downstream and also to the midstream. And when you think about the financial dynamics of the downstream and the midstream, you start talking about things like crack spreads. You start talking about seaborne LNG prices, you start talking about tolls for storage and for pipelines and things. And I think you can start to understand that actually the exposure to the oil price and to the upstream is much lower at Rotork than it is for one or two of the companies that people might see as being more as natural peers in the stock market. They're much more exposed to that upstream, which is much more sensitive to WTI and Brent and things like that.
Thank you. Someone has flagged up the EPS consensus on Stockopedia, which is a site that quite a lot of private investors use. They say the Stockopedia show consensus EPS of 2025 of 17.2p. Maybe you might be able to, I don't know if you can comment where that compares to the analyst consensus that you have in front of you, but that's the number that is flagged on Stockopedia.
I'll check it.
Yeah. But I appreciate you flagging that up for us to check.
Thank you. Next question then. Are you like Rolls-Royce insofar as you make a lot more on service rather than the original equipment?
No, we're not actually. We haven't really disclosed our service margins. However, we already make very good margins on our products. So we're not a razor blade type model where we make low margins on our capital equipment and then look to claw that back on the service equipment. We already make very good margins on our products. And if you look in our accounts, you know, our gross margins are circa 50%, okay? And then service is accretive to that.
Okay. And look, just a reminder, if you do want to ask a question, please type it into the Q&A box at the bottom of your screen. We've got one remaining or one outstanding question at the moment, so I'll ask that. And if you do want to ask any other questions, please put them in because we've got a few moments. So question we have here is, do you face serious Chinese competition despite your long history of excellence? And how many field engineers do you have?
It's a good question. So overall, I would say no, we don't face serious Chinese competition. You know, we've been in China for over 20 years. We're still, you know, the China business is very good for us. And it's because of the criticality in terms of the applications and the nature of the applications that we do. A lot of these applications are for exports out of China or for critical applications within China. And due to the relative price of our actuator versus the relative scale of what it could cost to go wrong, you wouldn't really replace our actuators for a 10, 20, 30% discount because there's too much riding on what could go wrong. So that's where the moat is, that's where the barriers to entry are. Where we do find it more difficult to compete in China is in applications where you don't need that super high-end premium product. That's where the local Chinese companies will go for a local brand. We never had that in the first place, so it's not anything that we would lose. However, this is why we are excited about Noah, because Noah actually can fill that space, which is good margins at the right price, which carries a Rotork brand name. So that's actually one of the areas where Noah can give us an uplift to be able to access markets where our products were, let's say, too good to enter in the past.
Thank you very much. We've had two other questions come in, so I'm going to ask those now. What could service revenues get to as a percentage of group over time? Or put a different way, what is the attach rate and potential for this to grow?
Yeah, the service is a huge driver for growth for us. We haven't actually set a percentage of sales for service because it actually depends. I wouldn't want service to be 30%, for example, with the group business growing at 1 and service growing at 10 over the next few years. So what we're actually saying is that the target we're setting is the service business has got to outgrow the group business. Okay, so and you can see it in our 3-year numbers. If the group is growing 10, service is growing 14, and that's where we want to pitch it. At that rate, obviously the percentage of sales will be slower, but overall it's a really good benefit for Rotork. So that's why we haven't set the percentage of sales. More so, service has got to really outgrow the group revenues as a whole. In terms of the attachment rate, it's different for different product ranges, but for electric actuators, we typically service over 90, let's say 95% of everything that we sell. So to service our electric actuators, you need special codes, you need special software and equipment to plug into these actuators. Other service companies do not want to do that because they invalidate warranties, or we won't basically support anything that's been kind of broken into. So because of that, end users typically will use Rotork to service Rotork products, and that's quite predominant across the globe. So for electrics, it's pretty high, and we pretty much service most of our electrics. For more fluid power type equipment, that's less, because local maintenance companies are more willing to service mechanical elements. But on electric, it is very high, and electrics currently represents circa 55% of the portfolio.
Okay, thank you. We're going to move to our.
But in a slightly,
Andrew.
Answer the question perhaps in a slightly different way. I think the thing that we tend to talk about a little bit more now is, rather than necessarily the attachment of service on our electric actuators, but almost the pace of securing that attachment, if that makes sense. So perhaps going back some time, a customer would buy a Rotork product and we wouldn't necessarily hear from them for some years before there was a particular reason why they were looking for service, and that could have been 4 or 5 years after commissioning and installation. But the trick, and what our teams are really trying to do now, is they're basically trying to accelerate that attachment. So they're starting to have a conversation with the customer probably 2 years after commissioning and installation, and starting to talk about a service package, a service campaign, the kind of things that you'd expect to do and things like that. So a lot of what we're trying to do here is not necessarily about increasing the attachment, because it's pretty good, but it's accelerating the time at which we get the attachment, if that makes sense.
Absolutely, it does. Sounds like a very sensible strategy. Last question here. Are you a big supplier to Goodwin valves and Czech nozzle valves?
That's a good question. Off the top of my head, I don't know that answer. So we'll have to find that out and get back to you.
Fine. Thank you very much for that. Well, look, thank you for the presentation, and thank you for asking all the questions that have come in today. We've sort of come to the end now of today's webinar. Just before I hand back to Gig to say just a couple of words, I would like to remind you that as you leave today, there'll be a short survey to complete. We really appreciate it if you could just spend a couple of moments completing that. And I know management find that very useful. So just before people leave, Gig, could I just hand back to you just to say a couple of concluding remarks?
Yeah, thanks, Alex. First of all, thank you for hosting. Thank you, everyone, for dialing in, and thank you for your interest. I mean, as you can see, Growth Plus is delivering our strategy. We're moving towards, our mid-20s operating margins, and we are delivering the mid to high single-digit revenue growth. So we're very pleased with performance. We look to continue that performance going forward, in conjunction with our continued capital allocation framework. So yeah, very good. Thank you very much.
Wonderful. Thank you very much, and we hope to see you all soon. Thanks and goodbye.
Thank you, everyone.